All right, let, let's begin the webinar. Good evening, everybody. Thank you so much for joining this webinar. Let us try and understand what the new budget has got it for us, and I'll try and cover as much as possible. So first 20 minutes about the tax implications and tips with respect to sale and repatriation of Indian properties, along with what are the tax implications with respect to that. Before we start, we have a disclaimer. This presentation is not a tax advice. Please consult your tax agents, lawyers before making any decision. I'm going to cover some of the basic points before we really get into the budgetary changes. The first one is that, should you disclose Indian property sale in Australian tax return, right? So it's such a basic questions, but, we often get it wrong. Permanent residents, tax residents, and citizens are required to disclose their Indian properties in their Australian tax return, right? So a lot of times, which is very insignificant, but it's missed out. You go to clause number 20 in your Australian tax return, make sure that you have ticked those boxes where you have disclosed that overseas assets above $50,000. Why it is important? There are so many ways in which the ATO will come to know about it. One of the basic fundamental things are the data matching challenges. Now, when we have an NRO account in the Indian banks, they ask for our TFN number. That means, essentially it will get disclosed to the tax office, and it's a mandatory for permanent residents, tax residents, citizens to disclose their global income, global assets in their Australian tax return. There are a lot of misconceptions with respect to, if I don't bring funds to Australia, so it is okay. Those are not true, and you need to disclose those informations correctly in your Australian tax returns. The second important point is about the financial year issues with India and Australia. In India, the financial year is 1st of April to 31st of March, and in Australia, it is 1st of July to 30th of June. Why it's not very advisable to sell properties during the overlapping months? Let us take April, May, June. One of my clients sold a property in April 2025. And in Indian context, this is, like a next financial year, which is a 25-26 financial year. From an Australian point of view, which is a 24-25 financial year. April is before, within June. So now the challenge is with lodging your tax return. So you have to lodge your Australian Indian tax return first before claiming foreign exchange or the dual tax exemptions in our Australian tax return. However, the client has sold a property in April 2025, so we will essentially lodge their tax return in India in somewhere in July 2026. So by the time we need to lodge Australian tax return, so it is so complex to claim the dual tax exemption. A lot of the time, clients miss out on foreign tax credit in this case. So try and avoid selling properties in April, May, June. Much better options could be December, January, every financial year. You get some time to repatriate the funds, lodge your tax return before 31st of March. Also, you will lodge your tax returns in July 2025. then we lodge Australian tax return based on the Indian tax return. Then we can claim the foreign tax credit in a much more efficient way. So there are a few changes which I would like to incorporate in the presentations itself. One of most changes are in procedural side. The tax rates remain same at 12.5%. Withholding taxes, of course, the tax liability can change. The TAN applications, I'll just give you a real life example here. One of our clients sold a property to the resident Indian. The resident Indian, rightly so, they deducted 12.5% as a withholding tax and remitted promptly to the tax office. However, in the old system, they need to lodge the TAN tax returns stating that okay, this money belongs to so and so. So it was not properly matched to our client's PAN number. Now our client entitles a refund from the Indian tax office because it is not mapped, and he's not able to claim the refund, and his return is stuck. So to avoid all this confusion in the budget, they have simplified this process. What essentially happens is that the withholding tax gets credited in withholding tax gets credited into your PAN account, which is already linked, so that we can lodge the tax returns and claim it at the appropriate time. So this is a really major welcome move, and much more simplifications than which is the current process. So simplification is good. It will help us in reducing paperwork. Then there is no change with respect of how many months or 1 year, 2 year to hold, to treat it as is a long-term capital gain. So your asset should not be treated as a short-term capital gain. The short-term capital gain has a much more higher tax rate than the long-term capital gain. The long-term capital gains gets much more tax efficient. Then you can reinvest and claim exemptions and all of that. So I'm just going to touch upon the securities, right? There are two different rates now. One, shares, securities, mutual funds are taxed at a rate 10%, 20% respectively. When you invest outside the gift city, gift city is from Gujarat, that the financial model the tax office has created. So if you are making an investment in a gift city, banks or mutual funds or anything, so capital gains are exempted, and the dividend incomes and interest incomes are taxed at zero or at a reduced rate. However, the word of caution here, even though those are exempted from tax in India when you invest in a gift city, but these are subject to taxes in Australian tax office. So there is no exemption, no changes with respect to in Australia side, but there is some changes with respect to India. But if you take a traditional way of investing in any of the shares and securities, it continues to be taxed at the same rate. There is a parity there, and we can claim dual tax exemptions for the interest income or the dividend income respectively, right? So for there is no parity between residents and non-resident. Why do I say that? So if a resident Indian sells a property to another resident Indian, then there's a withholding percentage of 1. But when a non-resident like us sell a property in India to the resident, the withholding tax is at 12.5%. So people wrongly assume that it's a 1%, because many of the lawyers also they don't understand that 1% belongs to residents and 12.5% belongs to a non-resident. I want to make another comment about the lower withholding of tax at that point of time, which I'm going to cover it in the next slide. Now let's move on to how we can save some taxes with respect to a low rollover benefits. There is no much changes with respect to the rollover benefit, which is still continuing as it is. So as you may know, if you sell a house in India, you can buy another house, or in terms of, if you sell your shares and securities, you can buy another house, and you don't literally pay any capital gains tax in India when the rollover provisions applicable. And that is true for bonds, the rural electrification bonds or any other investments. These bonds are generally held for 5 years, and any interest on these bonds are subject to taxation. There is no exemptions there, but the bonds per se, there is no capital gains as such. Now, the important point here is that instead of buying one house, you can buy two houses and still claim capital gains exemptions. And there is some changes for the repatriations of sale proceeds as well. So, where you can repatriate maximum of two house properties sale from India to Australia. So there is no issues there. So there is some relaxations on that part as well. But mind you, when you buy another house after selling your current property, there is no capital gain tax in India, but doesn't mean that there is no capital gain tax in Australia. So Australia will continue to have those capital gains taxes. So it is better, those capital gains are added to your existing income, your salaries, or your any other income. So it is better to calculate your tax liability here in Australia and work backwards and see how what we can do. In a very recent case where one of our clients wanted to invest in a bond for family reasons, or he wants to have another apartment after selling a very major big property. So after considering the tax liability, even though he's saving some taxes in India, so his tax liability is going up in Australia because he's already in a highest tax bracket. So we advised him not to reinvest. And it's very hard, right? Your money is getting stuck in India for another 5 years. Then you'll have to do the repatriations and all that process once again. But if your situation is not so, then you feel free to explore the rollover options. Like I said, there is a dual tax exemption treaty benefits between India and Australia. What that means? If you pay any tax in India, we can claim it here in Australian tax return, subject to dual tax exemption treaty benefits. That means if not all, so whatever you have paid there, so we will consider it here. But your tax situation here also plays a very vital role. Based on that, you can claim the dual tax exemptions. Trust me, it's not that really bad at all. 60-70% of our clients don't end up paying any taxes in Australia after claiming the dual tax exemption rules. So it is more of systematic disclosure in your tax returns and claiming that foreign tax credit so that you don't end up paying anything else. This is what I wanted to touch upon at the earlier point. Where, see, the withholding tax is at 12.5%, but you can apply for a lower withholding of tax certificate. What does it mean? This is a very typical case which has recently we have dealt with. The client was sold a property and the resident Indian has done 12.5% withholding of taxes and remitted that money to the tax office. Now, when we calculated or computed the tax liability for this client, and his tax liability was just under 6%. Now, so 12.5% has been withheld and remitted to the tax office in India, but his actual tax liability is only 6%. So now we have to lodge a tax returns in India, claim 6.5% back as a refund. Claiming refund is a lengthy process. Now it is much more streamlined, thanks to the tax office there, but it will affect your cash flows, right? So this 12.5% is applicable on the sale price, right? If your property worth 1 crore rupees, then 12.5% applicable on 1 crore rupees, not on the gain or the capital gain, nothing. So it's on the sale price. So you will have to factor only 87.5% as a cash outflow in that situation. Now, what has happened, this client of ours has already made a payment, a deposit to another property here in Australia. So urgently he wanted funds. Now he realized that 12.5% is going to get stuck there. So we lodged the lower withholding of tax certificate. So he could get approximately 94% of the sale process straight away refunded, and we repatriated those funds to Australia so that he could make a deposit. And it was a really worth the efforts, if you're really looking to get that cash flows sorted quickly. Couple of points I would like to touch upon here is about NRO accounts, PAN, and KYC. These are simple, basic stuff, and now the eKYC is also been approved. The process are getting much more simpler, and the clients are finding much more easier to sell the properties in India. No longer there's a endless paperwork. Now it's much more definite rules, clear processes, but still sale of property has its own issues, so which we need to look into. PAN card, make sure your PAN is active and you log into the tax office records and find out if there is any old items pending there. And if you have earned any rental income or any other income, you have disclosed it, lodged your tax returns in India so that that can be clubbed properly in your Australian tax returns. And same rules applicable to the NRO account. So the client of ours has sold a property, money got deposited into the NRO account. It will never get deposited into the NRI account. It has to be an NRO account. NRO is a non-resident ordinary account. So then upon the deposit, he realized that there is a freeze on his account, and they wouldn't let him take any money whatsoever before doing a KYC, before doing all those due diligence, which has been pending for years and years because there's never activated it. So that is the last thing which you want, is that your money getting stuck in Indian banks. So make sure you prepare your documentary evidences in terms of PAN, NROs, KYCs, and tax returns. Keep it ready so that whenever you sell your property, make sure that your proceeds could be repatriated very quickly. There are a couple of other points which I would like to highlight. And before that, these are incomes, and I would like to touch upon some of the expenditure which you can claim, right? So if the travel is exclusively for this purpose, there are rules associated with it, and you can claim expenses or expenses towards selling, right? Selling expenses, lawyer expenses, our fees, and buyer's brokerages, and every expenses towards sale of this property, you can always claim it. And at the same time, The other fees which you can claim is towards, if there is any stamp duty contribution which you have made as a part of the negotiations with a buyer, even that can be claimed as well. So make sure that you claim all your expenditure towards the sale of the property. Now, coming back to the income side, agricultural income, which is exempted in India, it is not taxed at all, but however, it is continued to be taxed in Australia. And agricultural property sale, which is completely exempted from the capital gains, but subject to taxation in Australia. But there are different rules which we can always consider while claiming the dual tax exemption, because you don't pay much any tax in India. So it becomes a different concept altogether. So let's look at NRE deposits. NRE deposits are exempted from tax. We have discussed about gift city investments exemptions. So somewhere similar to that, in FD's interests are exempted. Dividends are partly taxed there, so that will continue to be taxed, added to your normal income. So if you are in the highest tax brackets, then probably you will end up paying some taxes there. Rental income. There are a lot of questions on the rental income side. Let me give another one example here that, they often rent is received by parents or relatives, and the rental income has not come to your bank account doesn't mean that the rental income is not taxable in Australia. So whatever happens in India, irrespective of that, if you're a owner of the property, if the property has earned income, that needs to be disclosed in the Australian tax return, right? It's a similar concept applicable when properties are held jointly, husband and wife. Probably, rental incomes are going to the one person's account and not on a joint account. Those things has to be segregated and disclosed in a right way. And we have covered about the mutual funds and shares. There are some small changes here and there with respect to security tax, and those things are exempted on a part of, they are trying to attract NRI investments in India, maybe. So that's the reason they have made all these things much more simpler. Gift is another area which I will discuss that point in the next slide. Pension funds, PPF, EF, all of that. Unfortunately, these are exempted in India, but it is still taxable in Australia. But PF has two components. One is a taxable component, one is a non-taxable component. Non-taxable components, you can repatriate it, there is no tax or anything. But from a tax, the other taxable components needs to be added to your income as well. But there is an exemptions available. Please consider that. Insurance, oh my God, it is such a complex insurance packages from the LIC of India or any other insurance. It's all clubbed with life insurance and the investment portion. Obviously, the life insurance is not taxable, but investment portion is definitely taxable. And make sure that whenever they don't disperse that insurance proceeds in one go. So it's often does it at the end of the policy mature date, and then we have to work backwards and find out what can be done and everything. So with respect to if you're a partner in a family business, or you're a shareholders in your family business, that is something which you need to be disclosing it here as well. So there are implications with respect to business income which you have in India. Gift is a very interesting area. There is no gift tax in India. There is no gift tax in Australia. So let us be very clear about it. But it is very peculiar that in India, gifting between relatives are exempted from tax. But in Australia, gifting to the charitable institutions are exempted from tax. So there is a disparity between what the Indian tax law says and the what Australian tax law says. This is something very important when I get to hear that if you transfer your properties to your parents and parents sell it as a Indian resident and give the money back to you, that is exactly this clause is covered. So the moment you gift your property to your parents, which is a taxable in Australia, so you need to pay a capital gain for the gift which you have made to your parents, even though there is no gift tax, but it is a part of the capital gains tax. So never sell your properties to your parents, then ask the parents to give the money back to you. So which is not uh, as per the tax laws in Australia. So that's why it's very different rules from the gifting point of view. And same similar issues which happens in when couples owns a property jointly. So one person sells it, one person receives the entire consideration, but legal document says the property is jointly owned by both of them. If that is being the case, then you need to segregate both and make sure that both are disclosing their capital gains independently. If there is not expressly stated about the percentage, then obvious choice is that you should make 50-50. There are other points which you can look at it in gifting. Is grandparents gifting uh, FDs and money to grandkids who are Australians, right? So they usually do birthday gifts and keep it in the bank account. Then you won't realize it that these FDs are in the name of Australian citizens. So in Australia, the minors less than 18 years of age is taxed at a highest marginal rate. So this income needs to be clubbed with parents, or needs to be disclosed it in a manner which needs to be disclosed. So this has come to our notice now, because the tax office, with their data matching with the NRE FDs and other things, they got these informations and they are sharing the informations with affected clients. So 250,000 liberal remittance scheme is applicable for resident Indians. For us is approximately $1.3 million, which you can repatriate without much hassles. The process remains same. You need a certificate, which is 15CA, 15CB, and the process also is pretty much remains same. You can approach the bankers. The banker would ask the certificate. We issue certificate based on the documents which you submit, and also find out that okay, your funds have suffered the taxes and it is good to go out of country. So once you have that approval, then the bank will do the transfer directly to your Australian account. It not necessarily that you have to transfer your funds from NRO to NRE. You can transfer your funds directly from NRO account to your Australian account. Absolutely no problem whatsoever. Couple of things I thought I should highlight. In India, if your rental incomes are below threshold limit, then you don't need to lodge your tax returns in India. But even if the rental income is like $1,000 equivalent, still that rental income has to be disclosed in Australian tax return, irrespective whether you have lodged your Indian tax returns or not. The other thing is that we have already disclosed, make sure that clause 20 is ticked, and if you have any foreign assets, and this is typical case where um, the client has sold a property. Now the CGT capital gains tax has come through. So we realized that he never disclosed this property in the Australian tax return. Lucky for him, this property was not earning any rental income. Then we could disclose the property, disclose the capital gains, and be done with it. Just imagine this property is now you have rented it out. Last 3-4 years of a rental income needs to be disclosed before declaring the property for the capital gains. So that is a typical problem which you are going to face if you are not very careful with that. And we are not allowed to have savings account. So you can have only NRO account. NRO account KYC will irrespectively will come with a TFN number these days. So PAN is something you can log in and check if there is any bad news for you from the earlier records. And if you have other, please link it. It's much easier. If you don't have, that's absolutely all right. It's not mandatory for us to do that. So what we do, we help Australian permanent resident citizens to sell properties in India much tax efficient way, and we guide them with the processes and everything. Make sure that they pay as minimum tax as possible, considering an Australian tax position as well. Then we claim dual tax exemption, large Indian tax return, large Australian tax returns with dual tax exemption. Happy to connect with lawyers or real estate agents in India. And similarly, we have a network of real estate agents, lawyers, and financial planners and mortgage brokers here. And if you want to repatriate those funds and do some investments here, happy to connect them to anybody you want. Thank you very much for attending this webinar. Our team is going to share the recordings with you. And if you have any questions, please go ahead and put it in your chat box, and we will cover as many points as possible. So one of the questions which we ask is that the repatriation of funds when you have joint properties. When you have a joint properties, usually the money gets deposited into one person's account. Now the repatriation side of it, if you have a joint account, that is much more easier. And if you don't have a joint account, probably you are better off repatriating it separately so that you can disclose it at the right time. I've got a question here. I know there are a lot of questions, but I'll try and cover as many as possible from online, offline as well. So if you sell your Indian properties, you know that if you do a rollover transactions, you can buy another property and you may not pay any capital gains in India, right? But if you are an Australian tax resident, the rollover provision doesn't apply to the Australian tax rules. So it is disregarded for dual tax exemption rules. In Australia, the Australian capital gains tax rules applies. So just to give an example, you have sold a property for 100 and the cost of the property is 80 and you have left with 20 as a capital gain in India. So you have reinvested that 20 in another property, so you don't pay any capital gain tax in India, zero. Now, we will have to rework that for an Australian scenario. And here, 100 minus 80, maybe, subject to other dual tax exemption rules. I'm keeping it simple that 20% is your capital gains. Now that 20% will be added to your existing income. Of course, there is a discount of 50% applicable right now. And now comes to a foreign tax credit, you haven't paid anything in India. So you will end up paying tax here in Australia, even though you have done a rollover provisions in India. So hope I have answered that question. So I have another questions with respect to um, yeah, I think the rent received by your parents or your relatives are still subject to taxes here because you are the owner of the property. Then the other question which I have here is about one of the clients wants to sell a property and the consideration is received over the period of time, 3 to 5 years in a bits and pieces. So when is the capital gains tax applicable? So when you sell your property, capital gains tax is applicable, or when you receive your funds at a later stage. So when it is applicable, unfortunately, we don't have much choice there. So we need to pay capital gains straight away for the entire sale. Then receiving consideration at a later date is your choice. That nothing to do with the tax is concerned, right? So other question which I have here is about capital gains tax calculated at 12.5% on the gains. But I heard you mentioned that calculated on the sale consideration amount. Please confirm. So 12.5% of withholding tax is calculated on the sale price, right? Withholding tax is different. The tax rates are different, right? So when you sell your property, the buyer is going to do a withholding tax on the sale price. In our earlier example, so he's going to do 12.5%. If it is a 1 crore property, so he's going to do 12,50,000 and remit it to the government. Now you have to lodge your tax rate return. Then you say that my capital gains are not so much. My tax liabilities are just 6%, not 12.5%. Then they will give you a refund of 6.5%. So that is what there is a confusion about 12.5%. Tax is 12.5%, withholding is 12.5% on the sale price. Hope I have clarified that part for you. It is now I just welcome that the changes which they have made in terms of lower withholding of taxes. That is going to immensely benefit. So if it is an online, then it is something which you can consider. Now, just imagine the client has paid everything. It was 20%, so it has been remitted to the tax office. Now, just because it is not linked to our client's PAN number, he'll not be able to claim any refund, or the Indian tax office is withholding that refund. However, we have to lodge the tax returns with that foreign tax credit in place. Let me see if I have received any other questions with respect to. Okay. Let us see. So there is another question in online. So my lawyer in India has calculated CGT at 14.95%, including cess and etc. Is that correct? Is that changed to 12.5% from the next financial year? So the 12.5% is a standard base rate. Then of course there is all the cess and everything is applicable. But all these amounts are debited to your account in the tax office. Then you can claim the refund based on your tax liability. So that is unfortunately that is how it is. But lower withholding of taxes can save you. They need not have to hold 14.95%. They can continue to have, let us take 5%. If your tax liabilities are so low, if you can demonstrate it that your tax liabilities are 5%, then the lawyer can do 5% plus cess or whatever it is applicable at that point of time. So we are, yeah, I think we have covered all the points and observation. But the key point is lodging your Australian tax returns with the dual tax exemptions as well as the foreign tax credit. So that is where you're going to save some taxes. In from our experience, as I said earlier, 60-70% of our clients don't end up paying any taxes in Australia because we claim the foreign tax credit correctly, and that results in the taxes are paid in India and nothing much here. But in some cases, if they are already in a highest tax bracket, probably they will end up paying some money in Australia as well. Um, So can we lodge the lower withholding of taxes yourself? I think so. You can do that, but the process is not defined as such. Now, I think they are trying to simplify those, and it has been announced in the budget. The budget has not been passed. It's just a proposal. Hopefully, they will make it easy for anybody to apply online. So definitely, where you can submit the online application, give documentary evidences for the same, then you're good to go from there. I hope I have covered most of the questions online, offline as well. So thank you very much once again. Our team will reach out to you with a recording. We can take it to the next level. Thanks again. Bye-bye. Take care.